And at the bottom, in the end, we end up with a financial strength key figure. And so you can see the financial strength, but more important, you can drill up the tree and find the original causes why a company is strong or weak. And all of this, that's quite different.
All right, welcome back to another episode of Angels, Exits, and Acquisitions. I'm Jeff Barnes, your host. And today we talked to Dr. Holger Bartel out of Germany, talking about RealRate AI, a tool that helps with ratings agencies and rating companies for investment purposes, using AI and the next and latest FinTech startup that's coming out of Europe. So really excited about this interview, and I think you guys will be too. Now, one of the things I did try to get him to give us a really good indication on the economy and what's happening. He has a really funny story about how his tool helped him avoid a potential financial loss, even though he didn't give me quite the answer I was looking for on the economy. So stick around, watch the show, and as always, like, subscribe, and share. Thanks.
Welcome to Angels, Exits, and Acquisitions, the place to learn how to fund, scale, exit, and massively profit as an angel investor or entrepreneur. Brought to you by the Angel Investors Network. And now, here's your host, Jeff Barnes.
All right, hello, and welcome back to another episode of Angels, Exits, and Acquisitions. I'm Jeff Barnes, your host, and I'm joined today with Dr. Holger Bartel. Holger, how are you?
I'm fine. Thanks a lot, Jeff, for having me here.
Absolutely. Glad to have you here. I'm really excited to learn more about you and about your business and kind of your journey to where you are right now, because you are in a really unique and interesting space, the FinTech space, which is where I actually started a lot of my career when it came to investing in startups. So, Doctor, why don't you go ahead and give folks a little bit of your background?
Yeah, definitely. So it sounds like I'm just surfing the hype waves with FinTech and blockchain and AI. But to be honest, I had those on my mind years ago already. So, of course, as an entrepreneur, you need to find nice situations where you can finally sell your company. But to be honest, I'm mostly driven by having ideas, and I want to implement them, and I want to bring new ideas to the market. That's what I really like. So it's more about the entrepreneurial part. But of course, you need to earn a little bit of money in between. So that's very helpful.
Yeah, oddly enough, people will not give you what you want just for equity, right? You can't just eat equity. So you need to make a little bit of money along the way. So
that's what I learned.
For those folks who may be listening who don't know, FinTech stands for financial technology companies and startups and so on. And I started out when I was working with a large multinational conglomerate, Munich Re insurance company, actually based out of Munich. I was doing a lot of innovation and tech projects for them in the FinTech, InsurTech kind of space, as well as so many other things on that Gartner hype curve. And what I realized with that space is that, one, there's no such thing as one simple little vertical of FinTech, right? They're all across the board, and there's a number of different ways to look at financial services and financial technologies. So what got you involved in finance and technology in the first place?
Let me just go back because you mentioned Munich Re. I've been working for an insurance company belonging to Munich Re Group, so I'm happy to hear that you worked there. Munich Re, they're very innovative and having a lot of even technical guys, because, reinsurance means not only pricing, but modeling risks, catastrophes, weather changes. So they have mathematicians, physicists, biologists. They have everything on the team. And sometimes it feels a little bit like they are innovative, although they are very big. My understanding was when later on I moved to smaller insurance companies, the smaller they are, the more innovative and the faster they get. And somehow that's why I have my own startup now, because it's even smaller and we are more flexible. And in some specific cases, I hope we can provide even better solutions than the big ones.
Yeah, absolutely. When you're that big, I was in the Navy as well. And so we talk about it takes sometimes up to 20 miles to stop an aircraft carrier from full speed. So big companies are the same way. They can't just turn on a dime and alter course, because lots of layers of bureaucracy and politics and all of that. Not to mention lack of expertise in certain areas. And so that's where the small, nimble guy like yourself gets to come in and really take charge.
Indeed, when I was working in the insurance industry, that was when the idea for my latest startup sparked. So I was the appointed actuary of a German insurance company. And I was responsible to talk to the rating agencies. And each year I got the task to cherry pick those numbers that would be the most favorable ones when it comes to rating. And I presented them to the rating agency. And they never complained. And I was disappointed because I expected them to say to me, listen, you have a strategy. You are defining key figures. We want to see all the years the same key figures. But I did a lot of cherry picking and nobody complained. And I did not like this process. Plus, there was a lot of conflicts of interest involved because, one day the big boss joined and he told them, listen, I'm expecting you to give me a AAA rating. Otherwise, there are a lot of competitors out there. And so he put a lot of pressure on them. And I didn't like it. So I quit a well-paid job and I founded RealRate, which is, the first AI rating agency. And we want to change quite a bit. So we want to get rid of the conflict of interest. So what we do is we always rate all the companies in a given industry. And then we are the ones reaching out to the top-rated ones. So we are never under pressure. Also, I learned from the cherry picking. So we restrict ourselves to a lesser amount of data, only to the publicly available ones published in the annual report. But those are audited and I can benchmark them. And you see, that's where I learned how to do things different. And that's what we try to do now, indeed.
That's awesome. Yeah. And for the folks that don't understand the ratings world, I dove deep into this a long time ago just to understand it myself. And especially I was going to get my MBA during the financial crisis and the recession and really understanding this. And if I remember correctly, companies like S&P, Moody's, they were rating things. And like you were saying, now it makes a little bit more sense. They were maybe cherry picking the things that would give them a more favorable rating. Because then after the house of cards fell apart, they went back and said, we had to re-rate them and bring them down, right? And I remember they even did that for the U.S. government, for the treasuries at one point. They actually had to re-rate them. And in certain cases, it wasn't delisting necessarily, but going from a AAA to an A or an A-, it was just like, oh my gosh, I can't believe this. How'd this happen? And so it's awesome to hear that you guys are looking into all of this so that it does take that conflict of interest out.
Yeah, and indeed, those rating agencies, those are the ones putting like a AAA on a company or on a bond, something like this. But when it came to the 2008 financial crisis, you opened the package, you had a look inside, and it was not AAA anymore. So that's a problem. So the financial crisis in 2008, it was a rating crisis from my point of view, at least to a certain degree, indeed. And so a lot of things could be done better there.
So I'm really curious about this because just using the financial crisis as an example, was people were buying mortgages, bundling up, packaging up, selling collateralized debt obligations, mortgage-backed securities, all these different things, which the layperson has no understanding of, right? Let alone a way to figure that out.
Yeah.
So when you're talking about building an AI engine that can help with the ratings, which is supposed to give the consumer or the investor a little bit of a sigh of relief that what they're investing in is a good opportunity, which an investor could be a consumer investor all the way up to the hedge funds and the pension funds and things like that as well, right? But how do you gather that information? How is it possible for you to get enough information to really give them a good rating like that?
Before continuing, please subscribe and share this video to help us reach more people and stay notified of our latest releases. Now, let's continue watching and learning.
Yeah. So we are using AI, but in a quite different way that you might expect. Because if you say AI, you probably mean large language models, deep neural networks with hundreds of thousands of layers, with billions of parameters. So the big ones, they have 20 billion parameters to be estimated. We are playing in a different regime because if we want to restrict ourselves to audited data, we need to restrict ourselves to annual reports. And as the name suggests, they are published once a year. Unlike if you have, say, a self-driving Uber car recording thousands of signals every second with all the sensors and video cameras on board. So we have small data and not big data. And some people say, oh, this is boring. But I'd say, in contrast, we are able to use AI tools, although you just have few data. So that's the trick here. And in order to achieve this, what we do is we combine the AI approach, estimating some parameters, plus an expert model. And that's quite old-fashioned. So they came up in the 80s and they got abandoned. We have them again because from a data science perspective, if you have few data, you need to impose a lot of structure on the model. And that's what we do using our expert system. So this means we just end up with a few parameters we can perfectly estimate. And second thing is, we never do a rating just for one company. We always rank all of them in a big ranking and we publish it, which is quite interesting. So normally the bad ratings, they disappear in a drawer and nobody will ever see them in this world, but we still publish them. So that's interesting. And now we can do a benchmarking. So we have each company and we can compare them to the market average like a normal human being would do, identifying the strengths and weaknesses of that specific company compared to its competitors. And finally, we all of this draw this in a nice picture. So it's not a bunch of numbers or table. This is what we call a causal graph. Like on the top, we would put in the annual report data. Then step by step, we crunch them together. And at the bottom, in the end, we end up with a financial strength key figure. And so you can see the financial strengths, but more important, you can drill up the tree and find the original causes why a company is strong or weak. And all of this, that's quite different.
That's very cool. Yeah. And again, it would take a human, hours, years sometimes to try and figure this out, especially if we don't know what we're looking at or looking for. So being able to utilize AI tools to do all of that, I'd imagine I don't know if it's going to gain you a lot of popularity amongst the rating agencies, though.
Let's see. So next week, I will be having a call with one of the big ones. So, and from an entrepreneurial point of view, of course, I want to disrupt the market. I have new ideas and I want to profit from the fact that the old big ones, they are expensive. They're cheap, they're biased, they're very slow. So we can compete against them. But to be honest, they have the brand and we don't. So we have a great technology, but building a brand would need a lot of millions of dollars. And right now we are not at the stage. So what I do is focusing on great technology and then maybe in the long run partnering up. So that might be an idea.
No, I love that. That's such a smart way to go about it too, because like you said, and that's what I was doing. When I was working on the corporate side, it wasn't a matter of, big companies are great at operations, right? They understand finance, they understand operations, logistics, things like that. Startups understand innovation, technology. And so when you put those two together, it can be an incredible opportunity for everybody to grow and leapfrog to the next generation of technology or innovation, which is really a smart way to go about it. Now, with that all being said, this isn't the first time you've gone through the startup process, is it?
No, indeed, it's my third startup. So I had my very first one. That was when I was still a student in 1997. So that was before it got easier for fintechs to grow. Mm-hmm. And some years after we founded that company, we got Deutsche Bank as a customer. which was huge because at that time, being like 5 guys and having Deutsche Bank as a customer, I was so proud. And we got on Vista, which is now on Vista Bank. It's a well-known website in Europe for financials. So we got them as our first investor. And what we did in that company, that's financial forecasts of capital markets. So stocks, forecasting, interest rates, foreign exchange rates. And to be honest, I loved it. And the tech, again, was great, but strange things happened. So, for example, if you remember, it's a long time ago, the dot-com crash in 2001. So we had set up some portfolios, and our tool suggested you should sell all the stocks. And, well, the only effect we saw, we lost almost all of our customers because they said, I don't need you to tell me not to invest. And I guess 1 year later, they would have had a different view, but then we lost them as a customer already. So this can happen. And although you're right, you might get it wrong. You might be on the wrong side.
And if I understand what you just said correctly, you guys predicted, okay, this is not a good opportunity right now. Take yourselves out of these positions. Take the cash while you can. They said, no, we don't need you to, they're like, why would, the market's amazing. Why would I do that?
Yeah,
and then
definitely.
A year later, of course, we remember NASDAQ crashed and people were, because I remember I lost a lot of money in that one too.
Me too. But
so,
earning 0% instead of minus 40, that's a good deal.
Absolutely, right? Absolutely. Yeah, so to your point, you can be right and still be wrong. And this is where having models and showing and everything, even if it's incredibly logical and it's based on science and it's based on all the numbers and everything else, if it doesn't jive with humans' emotions, sometimes they're not willing to see it. They have that cognitive bias.
You're so right. As a side hustle today, I'm giving seminars to board members or supervisory board members in insurance companies talking about risk management. And, I tell them about the models like Brownian motions to model stock prices. That's quite abstract. And what we see is sometimes I play a game with them, just asking them to flip a coin. You see, I always have one here. So you can flip it in mind or you can really flip it. And then if it's heads, it's going up and otherwise it's going down. And then you can have a look on the chart. And then I ask them, does it look like a stock price chart? And they say, yes, it does. And then we can start to interpret it. And I'm doing some chart analysis on this, finding trend channels and all of this. But just some minutes ago, they were the ones by chance generating it. So from a psychological point of view, we as humans, we're really great in pattern recognition. So I guess that's why we evolved in evolution as one of the species being able to adapt, to understand, and to interpret what's going on. But this is working so fine that we're seeing some structure which is not there, which is just random. And so that's difficult. Sometimes it's great to have a tool to tell you, oh no, this is not a structure, this is just random. And data science and AI can help a lot with that.
Absolutely. Yeah, absolutely. And being able to tell the story within the data, right? And I think that's where a lot of people get it wrong, is that, and when I was going through my MBA, one of my first classes was statistics. And I remember the very first class that we had with our professor is Dr. Nye, and he said, statistics are amazing because they can tell you exactly what you need to know. Statistics are terrible because you can make the story whatever you want it to be.
Yeah.
Meaning you could exclude set data sets if you wanted to, you could exclude outliers, you could, skew the numbers however you really wanted to, and you can still say it's, well, this is what the numbers say. And I didn't understand that at the time. But going back to what we were saying earlier, with the ratings that were AAA rated and all of a sudden they're not, it's like, well, the number, of course, what we looked at was AAA rated. That was just fine. We didn't actually look at the entire data set. And so I think, to your point, it sounds like you kind of evolved this over time. Like, we know that the data tells a story, but how do we get that story across to people so they understand it as well?
That's so important. And that's why we focus on making AI explainable, because AI right now is working perfectly fine. You're getting great results, classifications, generated text and images. But when you assume you would be a board member and you want to take an economic decision, you need to understand what's going on behind the scenes. So it's a black box right now. And we make that black box to a white box, really showing how to explain the real causes. You know the good old saying, correlation is not causation.
Mm-hmm.
And having the expert system in there, we can show the real causation that is really happening for business decisions and to improve forecasts, to increase sales. You need to find the real triggers, not just correlated ones, and the correlation will break down once you go into practice. So a lot of companies out there, they are using AI and making it better and better. At RealRate, we are focusing on making it explainable and visually appealing, which is a total niche. But I guess many people, hopefully, I hope, they will value this in future.
Well, I think they will, right? As long as they can understand, what the output actually means and be able to say, okay, yes, we've proven case study after case study after case study, right? And I think that's where a lot of, again, our cognitive bias, our fear of missing out, and this is just typical. Most, especially the male species, are like, we're not always very risk averse, right? A lot of guys will just make a decision because it in our gut, it feels right. We look at it, we see everybody else doing it, we see the market's trending in this direction. We want to jump on the train. We don't want to be left out. We don't want to be the idiot left behind at the station. And so we'll make a decision based off of everything that we see around us. Meanwhile, the data sets are screaming, hey, that train shouldn't even be leaving the station, let alone should you be getting on it, right? And I think that's what you're saying is using real data so that people can make a data-informed decision rather than an emotional one that they can hopefully justify with logic later on.
Yeah, and I guess it will help male people, especially because, as you say, we're great entrepreneurs, to be honest, but we take so much risk, incredible and unnecessary. Maybe that's why the CEO of my first startup, it's a female. I guess at that time, she was the only female out of 20 guys. And it's great to have a female as a CEO.
Absolutely. So when I got out of the Navy, I was on a submarine and only guys. That's all I ever worked with was guys. And so we get out and my first boss was a female. She was my boss for a long time. And I remember at the very beginning, I was just so frustrated because couldn't take risks, couldn't speak out of turn, couldn't do this, couldn't do that. It was like being told, no, we got to think about this. Let's take longer. And now I completely respect it because she had a different paradigm and a different viewpoint. And I think that made it where, okay, I didn't like it at the time, but they were the right decisions to be made. And the only reason that even happened, making the right decisions, was because we brought in another set of eyes. We brought in somebody that had a little bit more experience and that risk appetite was tempered. And I think that's also what you can do with your tool, it sounds like, is help to temper or at least mitigate the risk, which in insurance, that's one of the things you're doing. You're mitigating risk as much as you can because you can't remove all risk.
No.
But if you can mitigate risk and take the emotion out of the equation, it really does help to make better informed decisions.
Yeah, and it really helped me to become an actuary, which is something like the mathematician in an insurance company. So my background is economics, and I had to go through studying to become an actuary. But it was great because at that time, it wasn't called AI. It was just basic statistics. But to be honest, like 90% of what you hear today of being AI is simply statistics. So I got all of this, fortunately.
Yeah, absolutely. And all right, so now since you're talking about RealRate, using AI, and you brought up the economics portion, I have to ask you, have you guys run any models on what's happening in this crazy world of ours right now where money's getting printed like crazy, the debt clocks are going up all around the world, central banks are, pumping money out as fast as they can in some areas. Yeah. Have you guys done any modeling on that? And what do you guys see happening?
Yeah, we have some nice case studies. So always, if a company gets bankrupt, I have a look in our ratings at that time, being curious whether we saw that coming.
Mhm.
And quite often we see that there's at least an indication that something could go wrong or they were weak. Very recently, you should know our business account of RealRate Inc. in the US was with Silicon Valley Bank. And I had some numbers, plus I had a bad feeling. And on Friday morning, I withdrew all the money. And on Friday afternoon, it was bankrupt. So sometimes it helps to have good data and good tools to analyze all of this.
That's pretty impressive. I mean, imagine if people knew about that before the bank runs back in in 1929 here in the States, right? So that's pretty impressive. Well, Dr. Holger, this has really been awesome. Tell folks how they can find out more about you and what's next on the roadmap for RealRate.
Yeah. So indeed, your podcast is for angel investors. So I would like to mention that next quarter, we will be starting a small seed round. So 2 years ago, we had a small European business angels round, and now I would like to have a small seed round. And the next big thing I have on my list is I would like to model private equity and correlate them with the stock markets we have out there to give daily pricings and indications of private equity. So you see, giving the technology we already have, that can be applied to quite some more interesting use cases. And have a look on RealRate AI. You will see all the ratings are free. And watch out. There's more to come.
Outstanding. Wonderful. So Dr. Holger, thank you so much for being here today. Really appreciate it.
Thanks a lot, Jeff. It was a pleasure.
And for those of you watching and listening out there, this has been the Angels, Exits, and Acquisitions podcast. Be sure to like, subscribe, and share, and we'll see you on the next one. Take care.